This week in India Business Report, is the record share price rise spectacular or speculative? Buying a car on credit, once shunned by Indians, it's now fashionable. Can a survivor of the Gulf War provide power to the Indian people? And a big name from the United States comes calling for $1 billion. Hello and welcome. This week share prices jumped to unheard of levels. The activity in the stock markets was uncomfortably reminiscent of April 1992, the month of the infamous Indian securities scam. Even at that time, speculators were talking about share prices being driven by strong fundamentals. The same language is being heard today. But this time the markets have a watchdog whose job is to make sure that nothing wrong is happening. Sunitha Kaul spoke to the usually low-profile Senior Executive Director of the Securities and Exchange Board of India, C.B. Bhave, and began by asking him if he was worried by the price rise.
Certainly as regulators we shouldn't be either justifying the price levels or decrying them as not justified. What we should again, to re-emphasize, what we should be looking at is whether there are any market abuses. And we have ordered an inspection of the Bombay Stock Exchange to see if there is any market abuse in evidence.
What are the checkpoints that small investors do not burn their fingers once again?
SEBI's role in investor protection can never extend to protecting the investor from the changes in prices in the market. That's a risk which is in the nature of this market, and any investor who enters this market must learn to live with that risk. If there is market abuse on the part of the intermediary, or the intermediary not giving the investor a fair deal in giving him the proper price or charging him the proper brokerage, that is where SEBI can step in. But if the investor loses on account of the market prices going up or down, that's not where SEBI can protect him.
Distortions still exist, like the book closure distortion.
I think it's been a little overplayed. When we looked into the book closure phenomena of the A group securities, we didn't find that the volumes in those particular securities were particularly high to give an indication that particular market abuse was going on account of book closures. But we are still investigating this with regard to the B scripts also. The uniform accounting year has also caused this entire phenomena to be bunched in a few months. But that is something that the market will have to live with.
Commitments are far exceeding shares during the no delivery period.
Now, if that happens, that will immediately be known the moment the delivery of these shares is demanded. And if the seller is unable to deliver, then the buyer has every right to ask for auction. And that is something that the stock exchanges as self-regulatory bodies must enforce.
Securities and Exchange Board C.B. Bhave. More business and market news later. A look at the new capital issues opening for subscription this week.
The Oriental Bank of Commerce is the first nationalized bank to go public since Parliament passed a bill allowing the government to dilute its stake in Indian banks. The bank will raise $116 million through the issue of 60 million shares at a 5-fold premium. The issue opens Wednesday. Oriental has been increasing business by a quarter every year since it was taken over by the government 25 years ago. However, it expects growth to slow down marginally this year. One of the major weaknesses of Oriental is its abstinence from merchant banking, a money spinner for most other banks.
Some of the figures of the projections need a bit of explaining. The cost of deposits and borrowings have been assumed to reduce from 8.13 to about 7.3 from the current year to 1996-97.
It is the interest rate which has been stipulated by the Reserve Bank of India. Earlier it was very large and we have taken deposits at a very high rate of interest. Now we are coming to the market driven rates, and that is one reason.
The main question before Oriental is one that all public sector banks face. Although it will offload part of its stake, the government will retain management control. This could prove a handicap once more private sector banks begin operations. Smaller customers could easily be seduced by better private service. Some of the public sector banks' largest clients, cash-rich financial institutions like ICICI and UTI, are opening banks themselves. Second-rung public sector banks like Oriental may need greater autonomy if they are to stay afloat. This is the first time that Sun Pharmaceuticals is going public. The company will float an $18 million issue that opens Thursday. Each share is being sold at 15 times its face value.
In this era of technology-driven growth, man's quest for a better tomorrow.
The company has moved up the drug industry ranking list from 107th in 1988 to 34th today. The last 4 years have also seen the company's turnover go up fivefold to $17 million. It is among the largest spenders on research and development in the industry.
They made a substantial increase in capital. There has been allotment at par to the existing shareholders and at a fairly low price compared to the issue price to TDICI. The capital has increased as a result of these capital acquisitions, and that has obviously diluted the earnings per share considerably. And that is one reason why I felt that the pricing is little ambitious at this stage.
A stringent environmental protection policy.
Part of the money raised from the issue will be used to treble capacity, while $14 million will go towards working capital. This seems excessive compared to Sun's current working capital requirements of $2.5 million. There is no mention of a correspondingly dramatic increase in turnover.
Sun Pharma, as a part of conscious business strategy, wishes to focus on export and other international businesses where maintaining large amount of inventory would become a necessary prerequisite of business.
I firmly believe that the working capital must be quite adequately funded. But I am concerned that many times people use the garb of working capital and use it for extraneous investments. That would be quite dangerous.
This week's new capital issues. Premium. We end an assessment of the week's new capital issues. First, the story of a small company asking for a large premium.
JAY Corp hopes to raise $3.9 million selling its shares at a 10-fold premium. The company has 2 directors who also sit on boards of companies promoted by the Ambanis of Reliance Industries. However, the track record of its present owners is questionable. The share prices of 2 other public companies floated by them have been hovering around 50 cents for the past few years. They are also embroiled in tax litigation. JAY Corp itself has just 153 shareholders following a public issue of shares in 1985. The owners are not subscribing to this high premium issue. Most of the products the company makes, tarpaulin and multi-layered bags, involve low technology, have low margins and face tough competition.
We are not worried because we have a technological edge because of our foreign tie-ups, and we have a head start over others of at least about 6-7 years. So, and we should be able to match the competition head on.
Orient Exports, a new company that plans to set up a joint venture with a Chinese company to manufacture refractories, hopes to raise close to $2 million with an issue at par. The Orient Group claims it accounts for 60% of the country's refractory exports through a sister concern, Orissa Industries. Orissa Industries has been reporting a healthy bottom line with an earnings per share of over 25 cents or 8 rupees for the past 3 years. However, 7 other companies promoted by the owners have been showing indifferent performance, while losses have wiped out the net worth of 2 others.
There has been some downtrend in the turnover because turnover is many times deceptive. Last year we did lot of production on a conversion basis where the raw material was supplied by the customer. So when the raw material gets supplied by a customer, then naturally the net turnover would decrease. But our profitability is only down by 2%. This is under a backdrop of a very difficult market situation last year in steel.
The whole issue itself basically covers 3 major projects. One is an export-oriented unit and 2 joint ventures. The 3 put together, given the kind of costs involved, I don't think make for a very profitable investment.
Malli Enterprises, a company owned by the promoters of Mardia Steel, are hoping to raise close to $19 million selling its shares at a 4-fold premium. Malli Enterprises acquired the shares of Mardia Steel through a convoluted series of mergers and amalgamations. The owners have 4 other listed companies and an equal number of unlisted ones, leading to apprehensions of more financial jugglery.
Well, it's difficult to evaluate the company because it's a mixture of 7 different entities, and one still isn't sure on how to categorize it.
This entire issue goes to Malli, adding nothing to Mardia's reserves. The offer price of $1.60 discount present year's earnings 24 times. Other steel majors are available at lower price earning ratios.
what is the PE ratio of the steel industry which is in loss. That is about 37 average. Where is this stock which has been offered at the 10 PE ratio?
The week's new capital issues. That's all in India Business Report this week. We'll be back next week with all the news and analysis. Thank you for being with us. Welcome back to India Business Report. Before we end, a look at what's on offer in the new capital issues market this week.
Arihant Threads hopes to raise a little over $7 million, selling shares at a 25% premium. This is the third issue floated by the Arihant Group in 3 years. Both the earlier projects were plagued by time and cost overruns. The promoters, though, continue to take large personal advances from the company and now owe over $65,000. The share prices of the two companies, Arihant Industries and Arihant Kotson, fluctuate around par and earnings per share are stagnant at 4 cents. Meanwhile, the Investment Information and Credit Rating Agency recently downgraded Kotson debentures, indicating default.
The downgrading has been done because certain funds which were tied up for the implement of the projects, because of certain institution coming in the scam, those disbursement could not take place, and ultimately whatever the resources available with the group was there, our first priority was that we should go ahead with the implementation of the project.
Some of the country's largest term lending institutions seem to have lost faith in the group. The Industrial Finance Corporation of India, once the group's largest lender, has stopped extending it fresh loans. The Industrial Development Bank of India, which has appraised the present project for foreign currency loans, has kept away from underwriting the issue. Analysts are also uncertain of the company's future profitability.
The projections of the company can be affected very much by government policies. Cotton is a very sensitive subject. The policies of the government fluctuate without any reason or relation to the business environment. So I think this element of risk will always be there in a company like Arihant Thread.
Akai Impex hopes to raise close to $6 million from the market, selling shares at a 5-fold premium. A successful export trading house with an earnings per share of about 30 cents, the company is plunging into manufacture. It is setting up a plant to make polyester filament yarn and knitted fabrics, but Akai Impex could have got its timing wrong.
The demand for polyester filament yarn has gone down substantially in the first half of the current year. This means the revenues are going down, margins are being squeezed, and then on top of that the government has imposed 100% duty on the texturizing stage. This means that the projections of the company they're going to go haywire. They didn't take into account these duties. On top of that, they've put POY in a super luxury item category. This means all the excise duties and all also going to come up, and the company's projections are going to go haywire.
The company is importing a second-hand plant for $15 million from Taiwan. The plant is expected to function for another 10 years. As the prospectus makes no mention of how much a new plant will cost, it is difficult to gauge the benefits of this. The import will place an export obligation of $65 million over 5 years on the company. Akai Impex, which has requested the government to reduce this obligation, has promised to pay the higher duty in case its request is turned down.
We are willing to go to Government of India. They're all right. Sir, if you want an higher export obligation, please reduce the customs duties to 0. Or if you want us to maintain the custom duties or whatever we are going to pay, please reduce the obligation, because it is fair that, you should be fair and equal to all.
The week's new capital issues. That's all in India Business Report this week. We'll be back next week with all the news and analysis. Thank you for being with us. Welcome back to India Business Report. Activity in the new capital issues market is expected to reach a new high in the coming months. We look at what's on offer this week with Karthik Chintamani.
Drug manufacturer Recon hopes to raise $3.2 million with an issue of shares at a 9-fold premium. Recon has doubled its sales every year and profits have been growing 200% annually. Sales in the first 3 months of this year are close to last year's levels. What is worrying though is cost of materials as a proportion of sales have been increasing. The company is also entering into an area in which it has no experience.
In fact, it is a related diversification activity in the sense that the approach to manufacturing, the approach to the formulation activities as well as the approach to selling activities more or less similar to our pharma formulation activities.
Weakness is that they're getting into areas like pesticides where a lot of small scale industry people are dominating, and secondly these people were basically traders and they get into manufacturing activities, so I think that might put them in some kind of problem.
The company's growth may not benefit investors buying into this expensive offer as it has a large floating stock of shares, almost 2/3 of the post-issue equity. 20% of this was placed privately at half the issue price in the last 12 months. These investors would be tempted to cash their shares on listing. The owners who are not buying into this issue have acquired their stake at par. Nagpur Engineering hopes to raise $4.5 million selling shares at a 7-fold premium. Originally a metal foundry, Nagpur Engineering plans to diversify into the unrelated field of soybean processing with this issue. This business involves a high degree of expertise in commodity trading.
It's basically they're focusing on the agro business, so if their cartelization and availability of soybean is not there, it's definitely going to affect their business.
With the increase in acreage, the total production of soybean is also increasing every year, as well as now government is also thinking of allowing import of soya also, which will result in additional edible oil, as well as you will be able to export de-oiled cake also.
97% of the promoter's contribution to this project comes from a bonus issue of 4.2 million shares made after a revaluation of assets. This means the promoters have hardly put money into the company in the past. Further, they are picking up only 1% of this expensive issue.
The week's new capital issues. After the American interest... Welcome back to India Business Report. Inter-corporate deposits, ICDs, are the latest game in corporate survival. Until now, only lenders were the big players. Car companies lent the huge amounts they collected in bookings at high interest rates. Now borrowers are getting into the act. These are mainly companies trying to make public issues at a premium in a depressed stock market. But the borrowing game carries a risk unknown to most investors. Sunita Kaul reports.
Early last year, the share price of Prakash Industries, a manufacturer of PVC pipes, began rising. Between January 1994 and March this year, it rose nearly 7-fold from $1. Analysts were surprised. Nothing had happened to warrant this escalation just before the company's public issue. The company insisted there was nothing unusual.
This volatility partly is a market phenomena, where it is the interpretation that the financial wizards and how they project. As far as the units are concerned, they concentrate on optimizing their operations and producing whatever the plant was meant for.
Even in depressed market conditions, when the BSE was 3,200 and your price was 170, 180, and when it was 3,400, which is higher, your share went low, that is 105. So it's not behaving even according to the normal pattern. Anyway, how would you explain the fact that there are rumors in the market? Not rumors, I have been meeting a few people, ICD people, and they say that Prakash Industries has been borrowing heavily under various companies' names. I mean, that you've been heavy borrowers from the ICD market.
No, I don't think that information is anyway correct.
After the markets crashed in the wake of the NS Shoes fiasco in April, Prakash Industries postponed its issue. It is now caught in a vicious circle, selling shares to repay debt and also borrowing heavily to keep its share value high. Its public issue has been rescheduled to the end of the year. But this time, the premium is lower at 78 rupees. There are other companies indulging in this practice.
So if you inflate your market price, you will get more money for the less equity. That's how it's starting. Initially you pump money into ICD, say you pump say 50 crores, but you brought out an issue to the tune of something around 500 crores. Then you pay back from the issue proceeds the same ICD money back. And like you, in the process, you collect quite a lot of money.
ICDs have become an attractive source of money, especially after the withdrawal of bridge loans. Cheap public issue cash is coming in. Companies take unsecured ICD loans and lend them at higher interest to make quick profits. Borrowing is simple. Loans have to be pledged against shares. The higher the share price, the higher the loan.
This is indicated by the fact that people are willing to offer. They started from offering 100% share security, their own shares. Then they started with 150%, and today even you get an offer 200% share security and 30% interest rate. So if ultimately they are not able to, the interest burden will be good enough and all this thing, they go bust.
The cost of capital in the ICD market is as high as 40%, thanks to brokers and merchant bankers. Analysts say the earnings of brokers and regular investors during dull market periods, especially in smaller exchanges, is indicative of this. Some companies are trying to milk the system. They park the promoters' quota shares, normally over 50%, with financiers to get ICD loans. Shares are cornered with these loans. Buying support pushes up the share price. When the price reaches the desired peak, the promoters liquidate and cover their positions. But unsuspecting investors are left with a hot share that suddenly plunges.
This activity starts even before the issue is open for the public. The promoter usually, or the operator or whoever is involved in the issue, it's not necessarily the promoter, he offers to buy back the stock 3 months or 4 months hence when the issue is listed at a very lucrative profit to the investor. You can give a return of more than 30 or 35 to 40, maybe 50%.
Redemption from ICD debt comes not from improved bottom lines, but from high premium public issues. But many companies have been forced to postpone their issues because of depressed market conditions, prolonging their repayments and increasing the interest burden.
You see, the exit route for ICD, short-term financing, is getting the long-term resources by raising the public money. If it doesn't happen, if the companies are not able to raise the finances from the public, that is what is going to happen, is a default, large-scale default by companies who planned their issues.
As things stand, the ICD market is a virtual free-for-all. Companies cannot lend more than 30% of their net worth, but borrowers have virtually unlimited access. If a borrower becomes bankrupt, ICD lenders get least priority in repayments. With the Securities and Exchange Board of India preparing guidelines for the markets, it is important that it looks at this issue to save investors from the cycle of corporate lending and borrowing.
That's all in India Business Report this week. We'll be back next week with all the news and analysis. Thank you for being with us.